Hi, welcome to March Madness. Who thought there'd be so many upsets in the banking sector? Hi, I'm Teri, and you're watching the Modest Economist channel. So, a couple of weeks ago, Silicon Valley Bank failed, and there's been a lot of upset in the markets, not only about that bank, but also about other banks, and whether or not this is the beginning of a banking crisis, and whether or not this is systemic. That's a favorite word of bankers, by the way, systemic. So today I'm going to try to do 3 or 4 short segments to give you the big picture on Silicon Valley Bank and my reasons for thinking this is not systemic. This is not another banking crisis that's even close to what we saw in 2008. The first reason is look at Silicon Valley Bank. What kind of bank was it? It was a very unique bank because it catered specifically to the technology industry. It was a community, and the depositors in that bank were also very unique. Mostly startups who have an infinite need for cash because they're startups, venture capitalists who are supplying them with cash, and the demands on cash were unique. Unlike the other depositors where they might just let their cash sit there forever. No, this is a bank that had a lot of cash turnover. Second, the investment portfolio of the bank was primarily long-term U.S. Treasury bonds. So we have 2 issues already. The bank depositors are not diversified, and the bank portfolio is not diversified. So in the classic terms of hedge funds and investments, this bank was highly leveraged. The bank really had all of its assets into one fairly small community, and that was the technology community. So what happens? The first thing that we hear is that, it's the Fed's fault. The Fed raised rates and they had this big portfolio of treasuries and they lost a lot of money and they weren't able to meet their depositors' demand. So let's think about that for a minute. The Fed has been raising rates now for 1 year. So it's not something that just suddenly happened. And what about the millions of people, other banks, corporations, pension funds, other countries that own U.S. treasuries? Prices didn't just fall for the treasuries that Silicon Valley Bank owned, they fell for all treasuries. So anyone who is invested in treasuries, whether they were short-term or long-term, lost money, or I should say lost value last year, because those are unrealized losses if you haven't sold your treasury bonds. But let's take a step back further. Any bonds that you owned over the course of the last year lost money. A lot of people lost money in the stock market too. So that doesn't make Silicon Valley Bank unique in the fact that it owned treasuries. What's unique is that they were not diversified, something we always talk about. So what actually caused the bank to fail? I think if we really look into it deeply, we'll see that there were specific people who sent out tweets, who were involved in conversations on Slack, who did the equivalent of yelling fire in a crowded theater. And as the mob looks to exit, some people get crushed, some people get killed. Who were the people that definitely got killed were the shareholders. Anybody who owns stock in Silicon Valley Bank has lost all of that value. So did people who yelled fire think about that for 1 minute? I mean, this is a bank that supplies their industry with loans that other banks probably are not going to make. But in any event, they did it. And yes, all the shareholders have been wiped out. So what happens? Panic. Everybody thinks that, oh my gosh, if this happened to Silicon Valley Bank, it can happen to other banks. Let's start looking at other banks. And if you watched what happened to the banking sector in general, stocks across the board fell. Actually, stocks across all sectors of the market fell. And when that happens, what do a lot of investors do? They start investing in bonds because bonds are considered safer. And what happens when you have a lot of people moving from equities to bonds or treasuries? That pushes interest rates down and it pushes prices up. So the irony in all of this is that by causing the bank to fail, interest rates dropped and the value of the assets in the bank went up. So if that one person or several people hadn't yelled fire, it's very likely that Silicon Bank would not have failed, just because market conditions would have allowed the Treasury portfolio to regain value. I'll just put a little addendum here. We know that the Fed has done most of the work, right? They've already raised interest rates, and there's a question of, are they even going to raise rates again this month, 25 basis points. So all the hard work and all the unrealized losses have already happened. It's more likely, if the people at the bank had understood Banking 101, that they would see interest rates come down probably later in the year. I mean, at some point the Fed will stop raising rates and will start to lower rates. The other thing the bank didn't do, which is really surprising, is they didn't hedge against higher rates. I mean, that for any active manager knows how to hedge interest rate risk, so it shouldn't have been such a big surprise. But when you combine all of that with the type of depositors that they have who really need cash all the time, they sort of caused the run on the bank by saying, take your money out. I'm going to stop here because I'm going to go to another segment that I'm about to create and talk about uninsured deposits. So I'll see you in the next segment. Thank you.